morning. This is the House Appropriations Committee. It is Friday, April 18th, 2025. It's about 10:50 in the morning. Floor went a little longer than we thought, but we appreciate our being able to start a little bit later. We have with us Patrick Titterton, Senior Fiscal Analyst at the Joint Fiscal Office, to talk to us about Vermont revenue collections. So we spend it, but somebody has to bring it in so we can spend it in this committee, and it'll be good to hear about the other side. And I know you've done this in other committees as well, so we appreciate you coming, Pat. And if you want to introduce yourself and take it away.
Yeah, so Pat Titterton, Joint Fiscal Office. I know you all have printouts, but do you still want me to share?
There may be people who want to see
Yeah.
it, so let's do that. And we'll try to pay attention to Dave and Lynn if they have questions.
Just I'll make sure we're on the same slide anyway, right?
Right.
Yeah, so it's my first time in here this session. It took all the way till the middle of April, I guess, huh?
You can't escape.
I do my best sometimes, but I hope everyone remembered to pay their taxes on Tuesday.
You mentioned it.
But yeah, so this is actually the same presentation I gave to the Ways and Means Committee earlier this week. I'm just looking at my watch, and it might be a little ambitious to get through all 50 of the slides before noon, but we'll do our best. If there's anything you want me to sort of push on through, you can let me know.
Thank you.
But, just want to say right off the bat, a lot of the things that are in these slides are kind of inherently involved in a lot of very political discussions nationally right now. So just want to let you all, or remind you all that our office is nonpartisan. I'm trying to give you that perspective on everything that I'm going to talk about. But something not so political is just how are revenues looking so far? So we've got sort of finalized figures through the month of March. And, in the general fund, we've collected about 1.7 billion. Ed funds coming a little under 600 million so far. And just to note, that's non-property tax revenue only. And then the T fund is about 230 million. One thing you can look at on this table here is over here on the right. You can see sort of where each of these funds is tracking compared to their monthly targets. General fund is 2.3% above, and what that means is, almost $40 million above, month-to-month targets so far. Obviously, April is the most important month of the year for revenues.
Question.
I can wait if you want to wait. I don't know if you want to take questions now.
Happy to have it be sort of a discussion, however you all prefer.
T fund, is that unusual for it to be down?
So, down compared to forecast, it usually is bouncing, kind of close to around where it's forecasted to be. Now, that said, when Tom and Jeff go and do their forecasts, they're cognizant of the fact that the gas tax is a declining revenue source, for example. So I actually think on this slide here, you can see that this is just comparing the July to the January forecast that they released. And really all I wanted to highlight for you all here was just that. So the general fund, Jeff bumped it up a little bit. The Ed fund, actually, they downgraded the non-property tax revenue forecast. But in the T fund, they're kind of looking at how things are tracking so far and, basically level from update to update. But the one thing that happened in particular, so you see right here, T fund was down is down year to date 2.3, but if you just look at the month of March, it's down about 2.9. Some of those particular misses are in DMV fees and purchase and use tax collections. And this is something we see quite commonly, is that we might miss by a somewhat significant amount in those two areas, but it's just because it's bleeding into the next month. So when you're looking at sort of the monthly target, sometimes there can be a little timing distributional effects that make it look like it's further down than it really is, because we're going to sort of claw that back.
So further along in here, we have some sort of what makes up each of these funds. So
yeah.
This is kind of the overview.
Yeah, this is just sort of top line. We looked at this. These charts are actually something that are brand new to our website. If you ever want to see this nice visual, you can go, it's right at the top tab. But it's just showing you sort of what it looks like month to month with the revenues coming in and getting up towards sort of the cumulative target for those funds. So like I said, it's about 1.7 collected in the general fund so far. Hopefully, we're going to get to about 2.3 billion.
Right?
So how do you, is the target what it was last year? How do you set the target? When you say target?
That's part of the consensus revenue forecast. So that's something that, you know, Tom and Jeff will come in and talk to you all about in January.
Forecast, it's a forecast.
Yeah, the target is based on the consensus revenue forecast.
So the emergency board meets normally in July and January, and that's when we agree on the consensus revenue forecast, and that consists of the governor and the four money chairs. So we met in January, and Kaved and Carr came and talked to the group, and they agreed.
So is it an estimation thing based on previous year's numbers or?
Well, there's previous years, and then there's a whole lot of stuff. And Tom came in and talked to us about it afterwards, and there's a whole presentation that's on the JFO website if you want to see what the consensus revenue forecast is like. Tom's presentation is there, but we also all got a copy of it. So it might even be on our website from the day that he was here, which is January 22nd or 23rd, something like that. You can find a whole lot that goes into it. It's a very
And it's if you go to our website, we make it really easy to find. It's in the featured publications section on the homepage. But so I guess maybe to go a little bit more into answering your question, they will use sort of last year's revenue picture as maybe setting a bit of a baseline, but they're also considering any changes to law that have happened. They'll be considering sort of leading market indicators in the economy and what other economists are sort of forecasting conditions to look like. And, you know, they even follow things like, you know, just unemployment numbers and claims at the Department of Labor. So there's a lot that goes into it. And like the chair said, they detail a lot of their sort of musings or thinking or justification for their numbers in the report, which you can find on our website.
So that answers the question.
There's a lot that goes, there's a lot of different like considerations that go into it. And yeah, so just to sort of give you a picture on what the general fund looks like and what it's comprised of, you know, over half of it is the personal income tax. And if you put both income taxes together along with corporate, it's about 2/3 of general fund revenues coming from just these two revenue sources. Obviously, meals and rooms, almost 70% of that revenue goes to the general fund. And then healthcare revenues is another healthy chunk at about 15% of total general fund revenue. So when I sat down and said, I hope you all paid your taxes, I think that if you look at that 55%, you know, over half of the general fund is coming from this one tax type. You know, that's by and large one of the largest chunks of money that supports the decisions that you all make when formulating the budget in here. This is just a few highlights. I guess in the interest of time, I'll just try and touch on this super quick. First, so far year to date.
Sorry, Pat, before we lose you on that, just on the personal income tax, how does that jive with using income as a means to pay for school taxes?
That's a big question. I'll try and give a quick.
Where does it fit in this number?
Okay, so I actually was in Senate Finance talking to them a little bit about this. So in a few years, 2 or 3 years ago, there was the summer task force looking at replacing the homestead property tax revenue with an income tax, right? So I think so for the existing law, the revenue estimate for personal income tax is about $1.3 billion for this fiscal year. Last year, the state collected net about $600 million in homestead property taxes. So if you think about replacing all of that revenue with personal income, you'd be basically taking the existing $1.3 billion that we are estimated to collect now and having to turn that into almost $2 billion that we'd have to collect from that one tax type. So just in terms of scale, you know, it's 50% again, more revenue from that tax type from what we already collect. And so one thing that's also important to note with that is with property taxes, you have the grand list. So tax base that you have is fairly stable year to year. But with personal income taxes, it's all dependent on people's income, which can vary from year to year. So in terms of what the actual base is, I know with both that you have to adjust rates up and down year to year. But in terms of just thinking about what the base is, the personal income tax is going to be more volatile than the grand list value that property taxes are based on. So that's sort of like a really quick synopsis.
It's enough,
Okay. Moving to the education fund. This one
Did you
basically,
mention the estate tax fund already?
I didn't,
Kind of got off on the other, which was fine, but this was an unusual year, so I thought you might
Yeah,
say
so
something about that.
maybe in like the last 20 or so years, this threshold has been tripped, maybe 4 or 5 times. But essentially in July, Tom and Jeff come up with an estimated revenue amount for the estate tax. And there's a trigger where if we collect over 125% of that amount, anything over the 125% of that amount is allocated to the higher ed fund. And so this year we've actually blown past that because we got a big slug of money. I think Tom was saying it's either the most or among the highest amount that we've ever received in 1 month from the estate tax. So so far we've collected about $43 million in estate taxes this year. And so 28 point
Forecast by
more than 125%.
Yeah.
So because of that split, about 28.9 million is going to be deposited in the general fund. And then the statutory allocation would then put 14.3 million into that higher ed fund. It's kind of a similar sort of statutory allocation figure that you might be familiar with, like with the property transfer tax, which is something that, kind of gets non-withstood every single year.
we did notwithstand it this year, let the record show.
You always have the option.
We can do that with them, we can notwithstand anything we want to notwithstand.
So yeah, that was kind of an interesting quirk. It doesn't happen super often, but we did trigger that sort of allocation.
There was one time many years ago, probably in, I don't know whether it was in the 80s or the 90s, maybe before that, I remember being told that somebody very wealthy died and it closed the budget gap that year.
Yes,
Do you remember hearing something? like that?
yes, at least once, yeah.
Yes. So you,
Yeah.
Maria, you remember that?
Yeah, no, that's how it worked once.
It's happened more than
Yeah,
once.
yeah, that's very true.
Yeah. Yeah. Go ahead, Jim.
On the higher education endowment trust fund. Where does that money go? Is that my question to the colleges, UVM?
I've got it out here, because I had the same question.
Okay,
What's really cool is that it's the non-loan financial aid. It provides non-loan financial aid for students going to state colleges or university.
so does it automatically go to them or do we have to, I just don't.
The statute provides that in August of each fiscal year, the state treasurer is to withdraw up to 5% of the 12-quarter moving average of the fund's asset and divide the amount equally among UVM state colleges and VSAC.
And it's financial aid.
Yes.
And it does it automatically. You don't,
It automatically does it.
yes, you don't have to appropriate it from out of it.
Okay.
So,
John,
So grants.
so Maria, so is that like discounting? Does that go like discounting? If it's a non-loan,
Okay, so that's a level of detail that I don't have.
just because I know, periodically colleges go through like discounting to attract students to come, give them a bit of a break on like the
It
total
could
bill
very
at the end of
well,
the day.
yeah, but I think that we have to check in with UVM and the state colleges to see.
I'll ask state colleges.
And
I'll
see
send
that.
out to Sharon's
It's
copy.
been awarded a president's scholarship, which is another way of bringing down the state price.
Probably related to that.
okay.
Okay, so ed fund, again, this is just sort of the same representation you saw earlier, largely coming in right around on target this year. And so ed fund, as you know, is quite unique, but there is a component of it that I personally track and send out the updates each month. So just to give you a sense of the composition, so sales and use tax, by far the biggest contributor to the ed fund in the non-property tax realm. It makes up almost 80% of non-property tax revenue. The ed fund also gets about a quarter of meals and rooms. And that includes 100% of that new short-term rental surcharge that went into effect last year, which is a 3% surcharge. And so that's about, it's almost 10%, and then purchase and use, they get about a third of, it's another 7%. But even the property tax revenue still comprises the majority of revenue that supports the education fund.
Used to be a third, and a third. It's changed a bit. Third homestead, a third non-homestead, a third all these other things. But it's not quite that same ratio anymore.
Yeah, I don't want to put my foot in my mouth and get Julia mad at me, but I don't know the exact split, but it's within that.
I think it's changed, and that's sort of broadly where it has been. It's a little bit.
So just a few notes, sales and use tax, it's slightly below its target for the month of March. But, overall, it's still about 4.71% above. So it's a lot of these you see here, they're tracking fine, with purchase and use. Again, this relates back to a little bit about your question about the T fund. This is just, similar, presumably a processing delay or just a timing thing that we'll probably see in the month coming forward.
And that's purchase and use is really about buying vehicles.
Mm-hmm. Yeah, that's the tax you pay when you go to register your car that you just purchased. Yeah.
Right. And there's nothing else in there. It's just vehicles, right?
I think so. I think you paid.
No. It just seems that then sales and use, we have use in two places, and that it's very
What is she
confusing.
about a vote?
I was just gonna say, I think that would just be sales tax.
Yeah.
Not.
Register votes, so I'm just,
Good question. Maybe I'll talk to Logan about that.
So it's starting to become very complicated.
yeah.
Yeah. Jim, you're chairing.
Yeah.
Does it come with a vote?
Yeah. That's where you call the meeting.
So T funds, you saw it earlier. Presumably the areas that it's down right now are usually things where timing can be a factor, but it's largely close to target. That's comprised of this one is kind of a third split between a few different tax types. Fuel taxes, gas and diesel together is about 28%. Purchase and use tax, 32%, fees, another 32%. So that's one where the funding is relatively balanced between, just a couple different tax types. And yeah, so, a lot of the gas tax, small dollar figure, 400,000 below target for March, but, that still equates to about 12 or 7.1% compared to target. Again, another fund where a lot of these things are coming in pretty close to what were targeted by Tom and Jeff. Except if you look again at the purchase and use and DMV fees, but in talking to Tom, Tom Cavet, likely going to be just a timing thing where we'll probably see that bump come back in when we get the numbers for April. So that's the part where with Ways and Means, we sort of transitioned into talking about a lot of things you've probably seen in the news recently. There are a lot of things happening federally that could, I'm not going to say will, that could sort of flow through and have some direct and or indirect impacts into several different tax types in Vermont and our revenue collections.
Patrick, I'm not sure if you're the right person to ask or not, but if Cavet were here, this is what I had asked him. There's obviously a lot of conversation, and we happens periodically on what of a normal cycle where you have economic recessions. So personal income tax is often directly related to the economic health. the sales and use tax, which is another major revenue for the source, is that more steady or does that fluctuate a lot as well during a recession?
I wouldn't say it fluctuates a lot. Like if you looked at a chart and saw how it has performed, since 2000, you'll absolutely see some downturns in it. During things like the 2008, during the Great Recession, during the dot-com bubble. There are some identifiable dips that occur. But because it's a very broad-based tax, and that's kind of a theme usually. The broader the base, the more stable it typically is. Because it's a quite broad-based tax, it does tend to be a little bit more stable. With that said, Vermont does exempt a lot of, necessities, something that would be not super sensitive to price. If you were to, see a price change or not, think like toothpaste. Things like that where you still need it even if you're in a recession. But a lot of the things that we do tax, think like a Louis Vuitton bag or like a luxury item like that, those can be much more elastic goods and the consumers are they react much more or identify substitute products much more readily, which can, those are predominantly a lot of those are the items that we do tax and do not exempt. So they can be a little more sensitive to, a change in discretionary income.
Well, I'm also thinking, the purchase and use, and when you talk about automobiles, there can be pretty good fluctuations, I would think, in that area. If car sales are down, then that revenue is going to be down significantly.
Yeah, I mean, the one thing that, has sort of seen since COVID is, the price of cars has gone up quite a bit, right? And when the price of those purchases go up, the new cars prices go up, raises prices on used cars as well. And when the value of those go up, it just increases the amount of tax that you then have to pay, right? So it's really, and I'll talk a little bit about this. There's a section on some of this information, but it really, for some of those ad valorem taxes, it really depends on if the change in price is fully or not fully offset by the change in amount that people consume, right? Because if cars, I'm making up a number, $10,000 more expensive, you might just make the repair and get the new catalytic converter on your old Camry or whatever, and just run with that for a little longer. So there's certainly sort of substitution behaviors and, just reduced consumption that can occur when prices increase. So these are the, looks like 6 sort of sections that I ran through with ways and means. If there's any on here that you think we can skip because of time, we can absolutely do that. But the first one that I had on here has to do with tariffs and the potential impacts they can have, like I said earlier, both directly and indirectly to various tax types in Vermont. And so sort of right off the bat, I just want to highlight here that there's a lot of uncertainty about all of this. It seems that a lot of tariffs that get announced are quickly rescinded. Sort of broad-based tariffs that were announced, all of a sudden we're talking about removing some carve-outs, adding in new carve-outs. So there's a lot of uncertainty in the business community, which makes it very difficult for them to plan because, a lot of their expansion efforts or hiring efforts, those are longer term projects that they work on that are difficult if you don't know what your, cost of goods sold is going to look like. And so they both have sort of indirect or direct and indirect impacts on consumers because of price increases, but it can also make it difficult for businesses to plan and strategize. So just quick overview, tariffs are a tax that are imposed on imported goods and services. I'm sure you know that. Recently, the federal government imposed near universal 10% tariffs on trading partners with a few carve-outs for things like pharmaceuticals, oil and gas, semiconductors, some electronic goods. But there's also been some indications that some of those carve-outs might get removed. And just as a reminder, the tariffs apply not just to finished products, they also apply to input goods. So if you're a manufacturer and you need widgets from Vietnam or whatever, it just might just be a small component of your process, but it's subject to the same tax. The supplier will be subject to the same tax. So there's those 10% tariffs, but there's also been several sort of industry product specific tariffs that have been introduced. A couple of them, I have a list on another slide, but one example here is a 25% tax on imported cars.
Which?
Vehicles. So just a little sense of the dynamic, a tariff increases the cost for a business to import goods. So the tax is levied on the importer. However, when they look at what the tax introduces a cost to them, and what they do is they will typically pass on either in part or in whole that additional cost to them onto the person who's purchasing the product from them. Which if that's manufacturer, that increases their costs, and they, on down the line goes these increases in costs that eventually reach the end consumer with the finished good and the product in the store. So while the tariff is technically collected and remitted by the supplier, the costs work their way on down the line so that eventually the end consumer is in a sense shouldering a lot of the burden of that. Increased or that tax. And just to highlight, global supply chains have gotten super complex. Vehicles manufactured in the US, they will often have their components crossing the borders with Canada and Mexico, a dozen times. And every time it crosses the border into the US, it's subject to the tariff for the value of the component or whatever stage of manufacture that good is in, or the vehicle.
So I have a question about that, and I'm trying to remember from Beyond Ways and Means, is it called pyramiding? The tax, so by the crossing back and forth and additional tax, pyramiding it doesn't really fit the definition of pyramiding.
I have to think about that a little bit. I guess, with something like a value added tax, if you've heard of it, if you're familiar with that, it's something super popular in other countries, but what they do is, so you have your smelting ore that you sell to a refinery to turn into steel. When you sell the ore, you collect the value added tax and pay that. But then when you buy a new machine for your ore operation, you get credit with the central collecting agency for the amount of tax that you've already paid.
Yeah.
So that it removes that sort of pyramiding or cascading effect where you're every step of the way, you're imposing a tax.
Mm-hmm.
This is a little different because I guess with crossing borders a lot, it does sort of multiply the amount of tax being collected. But once the goods in the US and it's, as long as it doesn't cross the border and come back in, it often, for those goods, it's just tax them one time.
Right, but if things are going back and forth multiple times, because now you've added another screw in Canada, and it's the third time, I don't know how to use a good example, but parts are going back and forth, and if you're making a car, there's different stages, right? And so maybe it's.
Yeah, and I know I saw shortly after, sometime earlier this month, Volkswagen, Stellantis, both two large car manufacturers that do a lot of manufacturing in the US.
Right.
They were actually shutting down production or pausing production at a lot of their plants that are on the border.
Yeah.
Because of the uncertainty that, we don't actually know what our costs are going to look like. We need to take a sec and figure out how many times does it cross? What should we be expecting that cost to be on us? Just because, like I'm highlighting here, their supply chains are really complex.
That's why I'm wondering if we're doing this sort of illegal thing that way, but.
I also see a news article recently where a Canadian manufacturer moved down, was part of this business into Richford, my district, and had the assembly going on in Richford to avoid the tariffs. So.
Maybe easier with some businesses than others. Car manufacturers probably harder.
Well, and actually, I want to, oh, perfect, it's the next slide. So you do hear some stories like that, right? Part of the issue that, this is a chart that came from the Federal Reserve, something they track. A lot of the businesses actually don't know if those tariffs are still going to be around tomorrow. So they don't know if it's worth the capital investment to move that production. So given the lack of sort of consistency that's going on right now, if we look at this chart, so what this is showing you is capital expenditures that businesses are anticipating to make. So something like setting up a new factory or increasing hiring or buying new machines to expand, that kind of thing. That big dip right there is, coincides pretty evenly with the announcements of tariffs, because they're still trying to figure out what to do.
Volatility.
Yeah, well, and it's showing uncertainty with what's going to happen in the future. These are referencing their anticipated future capital investments. And what you're seeing here is a really steep decline in what they're expecting to do. If anything, it could be the example you cited as a bit of an outlier amongst the broader industry.
Mine.
Just to quote the member from Chittenden, this is big. Business want stability. Like what you're saying?
Uncertainty, stability, volatility, but kind of all good words. Well, bad words, but appropriate.
So this is what the outlook is, or where we are so far?
This is a survey that they conduct. It's if in the top line, or sort of the title of the chart, it's in parentheses there, future only. So it's a survey of anticipated or expected or planned capital investments in the manufacturing business. So kind of bringing us back a little bit more to talking about Vermont and some of the, what we could potentially experience. And again, just talking about uncertainty, on April 2nd, Liberation Day, there was announced anywhere from 10 to up to 60% tariffs on pretty much every country in the world. And, Canada and Mexico were exempt from that, but earlier in the year, there had been announced 25% tariffs on all goods coming from those countries. Those were quickly rescinded. They're in a stage of being postponed indefinitely. So I guess in theory, they could come back at any time, or they could just not come back at all. But even with those, they're our two biggest trading partners. Even with that, there are some industry specific tariffs that are in place on goods like steel, aluminum, automotive imports that Canada and Mexico are subject to. And
They're 25%?
I believe, yeah, those ones are 25%. Last week, actually, the Department of Commerce announced that there would be a 34% tariff introduced sometime this fall. They didn't give a specific date on Canadian softwood lumber, which we import a lot of Canadian softwood lumber to build homes and cabinets and things like that in the state. We'll note there's like a existing 14% tariff. And I think back in December, it was increased to that amount from about 8%. So it's not sort of it's going from 0 to 34. There's an existing like 14% tariff on it. But, going from 14 to 34 is a significant jump. So yeah, the Canada and Mexico are exempt from the 10% sort of near universal tariffs on all the USMCA trade deal compliant goods. But again, these certain sector specific tariffs do apply to those two trading partners. So using the softwood or the Canadian industry specific tariffs as an example, we do import a lot of these goods from Canada in Vermont. So softwood lumber, Canada supplies about 30% nationally of softwood lumber used in construction. I couldn't get a Vermont specific figure, but I would anticipate that we're getting more than 30% of our lumber from Canada compared to, maybe Florida or some place down south where they have, I think it's called like Alabama pine that they use a lot in the south. And drywall also subject to the tariffs. A large amount of that is manufactured in Canada where they have a lot of gypsum and imported into the US, goes into building your home or renovations. Steel and aluminum. We don't really get a lot of this product from Canada in its raw form, but in the construction industry, they do import a good amount of steel goods like nails, beams, fasteners, again, all things that go into the construction of a home. So, putting these things together, tariffs have the potential to make home building much more expensive in Vermont, which would mean less development and growth in the grand list, which is really important to, support an education fund because the yield or the tax rates that are levied are based on a whole bunch of things, but the underlying tax base there is the grand list. And if that's not growing, as much as you'd want it to, that can have a negative impact on the tax base for that. And less development means fewer homes that are available for purchase. It can raise prices, which can be good for the PTT because you pay the PTT property transfer tax based on the value of the purchase. So that's good for that. But what happens if the number of transactions plummets because people either they can't get the money that they want for the home or they can't afford the new increased price or cost of that home. So again, it's a situation where you kind of think about, does the increase in value it is a smaller base, but does the increase in value get more than offset by changes in consumer behavior? So there's two examples there, property taxes and property transfer tax that, if tariffs take a bite out of construction, could be impacted. This is sort of highlighting, Chris Roop actually sent me this chart. This is a chart looking at new home starts, going back to, I guess, all the way back to 1960. But I guess it's not as easy to see in the chart, but what I want to share some stats from the article was that in March, there was a 11.4% drop in new home starts nationally compared to February. Single family home starts dropped 14.2%, and that's from February to March, and that's 9.7% lower than the same time it was last year. So it is somewhat of a volatile metric. Home starts isn't the most reliable thing to look at, but there's still somewhat reasonably large decreases in housing construction on the national scale. So one thing I've been talking about is this concept of, does the change in price have an outsized impact on consumer behavior? If any of you all ever back in school took the Econ 101 classes, this is where the whole discussion about price elasticity comes in. And I've got a great chart that I took straight out of a textbook on the next slide. But basically, if a good is very elastic, you're going to see more likely to see a big decrease in consumption of that good. Consumers are very sensitive to price changes for very elastic.
Elasticity means is the sensitivity of the price changes.
Exactly. And then conversely, if the good is very inelastic, price increases are less likely to change both the amount that a consumer purchases and also, how much you're willing to spend on it. So Vermont consumers buy many imported products that tariffs will put upward price pressure on because, remember, increases the cost on the importer. And a lot of those cost increases get passed down the line from the distributors to the warehousing to the wholesalers, all that stuff. So with the sales tax, purchase and use tax, we've already talked about these a little bit. They're ad valorem. It's a percent based on the value of the product, meaning that if consumers purchase the same quantity of those goods at higher prices, you're going to collect more money, and that's great. But if consumers purchase less, the increase in the value is likely going to be offset by reduced consumption, especially in those very elastic goods. And so just to sort of give you a visual representation of what that looks like, this middle chart here shows like if basically a one-to-one demand or one-to-one relationship. If a price increase is about 10%, you're seeing about a 10% decrease in consumption. What's different with an elastic demand is if, and this S to S1 line here is representing the imposition of a tariff and that price cost increase for businesses.
It's higher. There's a higher cost.
S1 is the higher cost.
Right. Okay.
And you can see that with this elastic demand, that Q to Q1 shift, the size of that area, just to see the sense of scale, is much larger than the change in the price over here. Inverse is true if the good's very inelastic. So what that really is just highlighting is if you change prices 10% here, you might actually get a 20% decrease in consumption, which would be a net drain on revenue collections for that good in the state. Conversely here, you might actually see those prices like a 10% price increase actually increase your revenue because people are much less likely to buy less of that good. Again, I use the example of toothpaste. I hope that's very inelastic for people.
We hope so. Yes.
So that's my Econ 101 textbook charts. A couple other comments I wanted to make. So tariffs do have potential for some, well, they do have some direct impact effects like we were just looking at with the sales and use and purchase and use taxes. Higher prices could reduce consumption, which could be a net negative on revenue for the state from those tax types. But again, they also likely could have some indirect effects, things that work their way through the system by changing, at the consumer level behaviors, which impacts sort of business decisions and business performance. So with the personal income tax, corporate income tax, tariffs have caused uncertainty for companies and have already led to production pauses, some layoffs. There are, I suppose, an example of increased manufacturing in Richford. But, on the national level, there's been a lot of uncertainty about, sort of business planning and whether they'll be able to maintain sort of business as usual right now. Because if their costs go up and they can't pass that off onto consumers, that takes a dent out of their profitability. And so on the corporate income side, decreased profitability decreases their liability, which flows through into the state. And if they're not as profitable and maybe they're doing furloughs or layoffs, then people are losing their jobs and they don't have that income to report when they go to pay their taxes, right? Now, again, I'll stress, I'm not suggesting that any of these things are absolutely going to happen. I'm just saying this is like things that could happen. We talked about the PTT a little bit.
Sorry, Pat, those last charts broke my head a little bit. I just want to take a half a step back so I can. No, show them anyway. I'm just trying to simplify this now that my brain is broken. So if there's a tariff on a product and we're saying that the importer is charged that. So if something costs 20% more to that importer, the idea here for the tariffs is that cost gets put into the product that they're selling now to the consumer. Let's just say they're recouping all their costs. So the cost of anything goes up 20% to pay the importer back for their tariff. So that's where we're getting hit. But we're also getting hit sales tax. So it's not just 20% increase in the price of something. It may be 20% plus 6 or 7%, depending on where your sales tax is, if it qualifies for the sales tax, never mind the purchase and use. But is that right? So a 20% tariff could end up being 26%, maybe not a 26%, but I'm going to pay an increased sales tax to the state. based on the increased price. That's what you're just saying about cars and housing. That applies to just about anything, right?
Yeah, I mean, with ad valorem taxes, like you said, they do increase with the value of the good product that you're purchasing. I guess maybe what's a little different is that the tariff it's being paid by the supplier of the good, right? So by the time it's stateside, the value of that tariff is just baked right on in. It's not really a specific line item anymore, if that makes sense. But yeah, it increases sort of prices twofold, like you mentioned. When it comes stateside, it's just is a more expensive good, and then when it's sold, that value of that good, because that cost is already baked in, does increase the tax you would have to pay.
I mean, it stood out when you were talking about the PTT. It's like, well, yes, if more housing is at a higher price, but fewer houses are being sold, and the PTT is actually going up. In our world, that's a fairly neutral thing to think about, but in a policy world, in terms of how much housing is created,
Right,
it makes a difference.
that's why it's sort of.
I mean, we could ignore that. I mean, very one-dimensionally, we could ignore the loss of housing if the revenue stays the same or goes up a little bit. Do you know what I'm saying? It's so I'm just, like I said, it's just all breaking pieces of my.
Well, the housing is a very difficult issue in Vermont right now that has a lot of different
We talk about
implications, right?
We talk about it with affordable housing, but it applies to single family housing anywhere. The same amount of money that we took from the PTT to put into housing now buys a lot less housing because of prices, the price increases.
I think we should study these
No,
charts
stop.
over the weekend.
No.
So, but let's talk about, so toothpaste we could consider inelastic because, that's kind of something we hope is inelastic. But what are some things when you think about elastic? So is it often things that are more optional for people? Is that kind of how it's generally thought of economically?
Yeah, I mean, if the cost of toothpaste goes from $1 to $5, you probably grumble a bit, but you still buy it. If the cost of your Netflix subscription goes from $10 to $25, that's a lower percent increase, honestly. But you might be more likely to cancel it because it's just, this isn't worth it. I'll just watch Paramount Plus or whatever.
And people on durable goods too, I imagine people put off buying a new refrigerator unless it completely died or.
Right, and that was sort of the example I was trying to use when talking about automobiles, where if the cost of an F-150 goes up $10,000, you might just, fix the transmission on your Camry for $2,000 or whatever. I don't know if that's a good deal or not, but it's sort of it's not just about quantity. It also factors in some substitution behaviors that people might make. So a lot of people need a car to get to work. So that, is something you need. And in theory is kind of inelastic, like, binary, like need one, don't need one, you need one. But substituting the new transmission as opposed to the brand new car is, that has state revenue implications if it happens on a widespread level.
Or getting a
Absolutely.
bicycle, I suppose.
Getting a bicycle.
Free work.
Right.
I had an employee who biked to work all through the winter.
It's impressive.
It was. Okay, thank you.
So I think we talked about PTT and CIT and PIT, a lot of acronyms, sorry. Meals and rooms, a lot of, so grocery items, not a taxed good in Vermont, but a lot of grocery items are imported, including a lot of produce. Something like if you go to a taqueria and you want to get the guacamole, the avocados are probably coming from another country that's tariffed, it's more expensive. It just increases costs for things like restaurants, just as the example. which then again is something that gets passed on. But you know, if instead of a side of guac being $5, if it's 10, you know, you might just stick with the salsa instead. So it has an impact in that sense. But also when we talked about PIT earlier, and if there's layoffs, furloughs, frozen wages, that kind of thing, it has the effect of reducing consumers' discretionary income, things they can spend on things they don't need, like going out for a meal at a restaurant. And so, you know, it has the impact, and we have to think about that not just in the sense of Vermonters' discretionary income, it's people from out of state as well, because we do draw a lot of tourists into Vermont who then go and spend this income on meals and rooms and things like that. So just quickly, like in sum, tariffs have direct and indirect impacts on almost every corner of Vermont's economy. How consumers respond to that and how the job market responds to all that and the business community responds to all of that is going to basically be what determines whether this has marginal impact on state revenues, a large impact on state revenues, whether it triggers broader economy implications that again have implications on Vermont revenue collection. You know, just a lot of different factors that I'm trying to sort of pull in together into one conversation. And it might seem like a little all over the place, but the reason for that is it kind of is. So
It is.
I just want to be cognizant, Madam Chair, of
Yeah.
how much time we have.
Consumer confidence, that's kind of important. And I know we have, we're hoping to have somebody come in from tourism. So let's just go through.
See how far we get.
Yeah, just
All right.
keep going. We are, let's just keep going.
Okay. Well, there'll be two sections all the way towards the end that I want to make sure that I get to. So
Okay.
I'll give myself a little buffer to skip ahead then.
Perfect. Thanks.
So consumer confidence, this is a consumer confidence index, is an economic indicator that measures consumer optimism about the current and future state of the economy. This is what we call sort of soft data or a leading indicator. It doesn't tell you anything concrete about what's happening in the economy right now or what will actually happen in the economy, but it tells you what consumers are thinking about. If they see rocky times ahead, they might say, well, I probably shouldn't make this big purchase and I should make sure that I keep myself on sort of financial steady footing because I don't know if this is all maybe exaggerated, but I don't know if I'm going to lose my job tomorrow and I just won't have the money. Maybe I don't need that new, $500 flat screen. I just stick with what I already have. So again, it's sort of the psychology of the consumer factoring into sort of spending decisions that may be a little bit outside of just changes in prices, right? So yeah, if basically the way the indicator works is if the indicator is higher, people are more confident. If it's lower, people are less confident. So in January, this index was at 71.7. And then by April, it's fallen to 50.8, which is the second lowest recorded number on since they started doing the survey in 1952. You'll notice the actual lowest recorded amount was really not that long ago.
Not that much different.
And not that much different. Now, and I think Tom's actually talked about this a little bit when he gives the all-member briefing. But if you notice the difference, so one is in 2025, one is in 2022, and one of the reasons that, it's kind of soft data is that baked in there probably is some political polarization. You have two different party presidents in those two timelines, so probably the people who are feeling not confident has sort of flip-flopped to a certain degree. But, another thing you can also think about is in June of 2022, what was a really big concern for everyone? Inflation, right? What is a big concern right now? Again, with a lot of the tariff implications, it's inflation again. So there's probably a degree to it that is a little bit connected to politics, but also, one of the themes that is consistent between these two low points is fears about inflation.
Yeah, Patrick, I appreciate that consumer is 70% of the economy. And I didn't realize we were down back to where we were at the start of the pandemic, in terms of confidence, which is concerning in itself, but are there any national indicators that have suggested that low confidence has already started to have an impact on consumer spending?
No, and I, it's part of why this is sort of seen as a leading indicator. It's not hard data, doesn't exactly correlate with concrete behavior changes. But it is something that economists or, investors will look at sometimes as sort of, if they're trying to read the tea leaves of what might come.
And that's like the biggest drop in a quarter of any of the things on here. I mean, if you look at, we dropped 20 points. You said from 71 to 50.8, so 21 points. So if I look at that line,
Yeah.
I don't see any other lines that long, except maybe in 2020 when everything shut down.
Well, and
It's
another.
unusual that it drops so significantly in such a short amount of time.
Yeah, and I'd also say one other thing to keep in mind. So June of 2022 was the lowest recorded for this particular index. And what happened right after that, we had a robust growing job market and economy. So consumers might have been feeling down in the dumps, but the economy didn't actually reflect what their feelings were.
Right.
But the federal government printed a lot of money.
Exactly. Yeah, they could. Right.
Different dynamic.
It's multifaceted for sure.
I guess it's just what people think.
Yes.
Right. And how they feel.
Yeah, right.
Yeah.
Turn off the TV, don't watch the news.
Go fishing.
There you go.
Head in sand.
Don't be worried about it.
Right. All right. So we've got to move on if we've got some other key things that we want to talk about.
So that was a really quick section. I mostly want to touch on credit markets because there has been a lot of market volatility, and in turn that has led to a lot of bond selling, which has increased interest rates. And actually, so just in the month of April, 10-year Treasury bonds have risen by, and actually this was as of Tuesday, so maybe it's changed since then, but risen by 0.3%, which is a small percent, but it's actually in the course of a few days pretty significant. And so just to give you a sense of what that looks like, average 30-year mortgage just since last week has increased to 6.83% from 6.62%. And we were talking about PTT earlier and home construction. So not only is the price of housing likely to be going up, you also have an increase in the cost to yourself of financing that purchase. And it's not just homes, it's auto loans, it's personal loans, it's credit card debt. These are just sort of scary visuals. A couple examples. So as of January, subprime auto loans were 60-day delinquency index had spiked 6.6%, which
Is this one of these charts?
yeah, sorry, I'm trying to skip ahead a little bit.
Yeah.
So I skipped these two. This is just showing the value of the dollar year to date
Yeah.
and the change in bond yields. This is showing you the NASDAQ and the S&P 500 since the beginning of January. All just to highlight a lot of economic uncertainty, which is likely leading to some of the bond selling, which is pushing bond yields up.
Okay, so here's, now you're at the delinquency.
I'm on slide 38 right now.
Okay.
And so it makes borrowing more expensive. Both businesses and consumers rely a lot on credit to fund a lot of purchases. A lot of Americans are already behind on their car payments in the subprime market. This has increased, 60-day delinquency rates have increased 6.6%. A quarter of student loan borrowers are estimated to have fallen behind on their payments. Credit card debt was at a record high of $1.2 trillion earlier this year, and 7.2% of balances are estimated to be in delinquency. So, there's already a lot of debt out there in the US right now. And when you compound that with higher interest rates, it just makes the cost of a lot of these large, big ticket item purchases more expensive. And so tax implications, purchase and use tax, if it's more expensive to finance, that could change your decision about what you buy or if you buy. for businesses, might restrict whether they want to do a capital expansion, or hire more individuals, which sort of can slow growth there. And again, with the price of that interest going up, it can lead to less discretionary spending that people have to spend on all those things that Vermont does to collect taxes on.
So when we think about these, and I know tourism is coming up next, and we could say the same. Are these sort of, I wouldn't say these were leading indicators, I guess, maybe they're concurrent, or I'm not sure what but
I'd
it's,
say compounding.
yeah. Because we are not going to see the effects of this necessarily this month or next month, that maybe,
Yeah.
further out before we actually see the effects of it.
I guess one piece of context I should also maybe have started with was, I was talking to Chris Roop the other day, and he had been talking to Tom Cavett, and sort of the sentiment that they have is that revenues for the fiscal year we're in right now, we're already most of the way there. A lot of those revenues are based on last year's income.
So,
We should be fine for this year. A lot of these things that I'm talking to you all about, they take time to work through the system. It's not an overnight thing. It's just something, if you're looking forward and thinking about maintaining the current service levels of the general fund or the other funds, it could put pressure.
yeah, I imagine that next January's e-board meeting will be a lot different than this past January's e-board meeting. I could imagine that. Let's just
Yeah.
say that. Yeah.
So you know what? We actually might be able to get through everything at the pace we're going at. There's 9 slides left, and I can go pretty quick on some of these. So
Worried about, for sure.
nationally, tourism accounts for an average 3% of any given state's GDP. That's not the case in Vermont. It's about 9% of our state GDP. So we do rely on it quite a bit in our economy. Tourism is estimated, this is from an ACCD study. Tourism is estimated to be a $4 billion industry in Vermont, hosting about 15.8 million guests annually and supporting about 31,000 jobs in the state. That includes spending on $1.4 billion on lodging, $830 million on food and beverages, $658 on retail spending, $581 on gas. Estimated to generate about $282.3 million in tax revenue.
Jim has a question.
Do you have a breakout of how much Canadian
Next
tourism
page.
I'm sorry. I didn't look ahead.
So I don't
Ask ahead.
I don't have like a complete report. I'm not sure if that's something that's specifically
And
tracked.
that's what we're hearing reports of.
Exactly.
Been impacted. I think the tourism, we obviously rely heavily on tourists from New York, Massachusetts, New Jersey, Connecticut. Those are going to be more reflective of any downturn in the economy. But Canadian is for perhaps other reasons right now. Okay, thank you.
Yeah, and so I don't have sort of a holistic full view of what share of tourists in Vermont are Canadians, but these figures you see here from the Kingdom Trail Association and Jay Peak Resort, those were something I actually spotted in a 7 Days article recently. So Kingdom Trail Association estimates they host about 135,000 visitors annually, and that about 40% of them are Canadian. Jay Peak, on the other hand, 30 to 40% they're estimating are Canadians. So it's anecdotal, but that's 2 examples of businesses that are sort of telling you what they think the share looks like for them. And it's
Here, John.
Right here. So, it appears to be anecdotal, but it's real dollars. I mean, some of our, I don't want to name a particular business here, or whatever, but, we have lots of small areas where there's a lot of, money's being spent gross, obviously here. I'm really concerned that, one of our really smaller communities could be down by $2 to $3 million in gross revenue kinds of things. People coming in to stay overnight. I had a meeting last Saturday with a group of folks in the Burke area who are asking questions about national stuff here. We started focusing on the potential economic impacts of things. There were a couple of folks that have inns that host those businesses and areas. And, they can't afford, there's always that temptation to maybe if we lower the price a little bit to attract more people to give them a break, but they just can't afford to do that kind of thing. And we've had places like, Jay Peak and some other northern resorts often over time here, not that we're doing it now here, but, provide, Canadians to attract Canadians to offer them on par.
Yep.
In comparison to the Canadian versus the US dollar here, but it's significant. And some places are getting a little bit more fill because now there's like room if more Canadians are coming, they're getting more, folks from the winter, filling some of those spots. So it's gonna be really interesting to kind of see how that kind of plays out as the tourist season starts in 2 weeks.
Yeah.
Two other things around the Canadian tourists. We had the treasurer in and he talked about tracking border crossings. They can get some information on that. And then flights, which would be national, not because we don't have flights from Burlington to, but so, and they're down, but it was just starting. They don't get it all the time. I can't remember what he said, but they are down. So he's been tracking that. And secondly, the other comment I've heard, again, totally anecdotal, but Canadians own property in Vermont. They own them in the islands and they own them at Stowe is the other place I've heard about. I don't have any numbers about any of that, but I guess there was, I don't know whether it would be concerned, but sales of property may occur as a result of that too. Again, we have no idea, but that was just, those were other areas I hadn't really thought about was home sales or second home sales in this case.
Yeah, there's actually there was a recent Wall Street Journal article about exactly that a lot of Canadians, it was specific to Florida. A lot of snowbirds, Canadian snowbirds selling their second homes. But yeah, I mean, they've got a home here and they don't like the climate that is going on right now that could spur some of those decisions. I don't want to suggest that 30 to 40% of the existing, Canadians would just stop coming here altogether, all of them. Like a lot of the reports that have been somewhat anecdotal, business to business, they've been seeing many Canadians canceling trips or plans. Not that they're all canceling trips and plans, right?
No, but a significant number. Wayne?
And Mike, can I just jump in real quick here before, if that's okay, Wayne, here. We're not thinking we're gonna have, all 30% of the visitors are not gonna
Right.
come here. There'll be some that will not come, and there are those who are canceling here for sure. But we have a lot of people that like to come, and they're still gonna come. It doesn't really cost them anything more to come to us because we're relatively close to the border. So we're, we have our Burke area chamber, we're gonna start engaging in a bit more to collect a little bit more hard information here, just to have some idea here, not to put a number, too much of a hard number on things.
Should be some historical evidence. I had a restaurant 3 miles, 5 miles from the Canadian border, about 3.5. From 1986 to 1995. 1991, Canadian exchange rate went to 40%. I lost 40% of my customers over that. Kill me. That was a major thing, but JP is operating right now, and given the snow year that we've had, would be a pretty good litmus test to ask JP how they're doing with Canadian customers, because they should be skiing. I think they had 84 inches of snow at the stake in Mount Mansfield this week. So
Yeah, they had over 400, over 450 inches of snowfall this year at JP. So it's just going to stay longer. And this is kind of an odd time of year because, ski areas kind of get to a point in the winter season where they're gaining a lot more money here because with all the season passes and all those things, but they still need to have that business to take care of all those things, which is not skiing.
There was a bit on the news last night about that, but it's that usually they start signing people back up for season passes and that way.
So this slide really is just about there's recent change to visas for that's now being applied to Canadians if they're going to be in the States for more than 30 days. They now have to register with the US State Department. That's not a requirement that the US had enforced prior to a couple months ago. But again, the only reason I just bring that up is it just highlights, it's another step that they might have to go through to come visit. So it's kind of comes to the like opportunity cost of whether it's still an attractive or whether Vermont still appeals as an attractive travel destination. Federal tax changes. I don't think because you all are spending the money and not raising the money, we need to dwell on this too much, but your Ways and Means Committee might have to be busy going through some of these things through the tax changes if they come to fruition, to support you. But I actually had no one put this together for me, and I think you all are familiar with it. It has to do with the hospital provider tax and the federal matching. So I guess are you all good with that?
Well, I have certainly heard that that's an area, a targeted area, potentially targeted area.
So we can go through this real quick, but if you want more information, have no one come in. So states are allowed to use revenues from taxes on healthcare providers. In Vermont, this is the provider tax to help finance the state share of Medicaid expenditures as long as they meet certain conditions. One of those conditions is that Vermont cannot hold providers harmless, meaning that states cannot guarantee directly or indirectly that the tax paid will be returned to providers to make them whole. So, as part of that, there is what is known as safe harbor, which is the presumption that this requirement is met if the provider tax is equal to or less than 6% of net patient revenue. The proposal that's been put forth is to take that 6% and bring it down to 3%. And so no one did a little number crunching on that, and what that would shake out to is approximately $104 million loss of state matched dollars to Vermont tax change, which would the equivalent, which would equate to a total of $252 million lost of gross Medicaid dollars in the program. That's why after you factor in the state match and the revenue piece of that. The last one just has to do with the federal civilian workforce in Vermont and their contractors. It's, direct civilian workforce, about 3,300 federal employees work here, so not significant, but there has been a lot of layoffs at the federal level, and part of that is canceling contracts with contractors. So again, if we see a lot of these canceled contracts that lead to layoffs in the state, that has an impact on personal income taxes, right? So one example is with all the recent USAID cuts, Tetra Tech, which is a contractor with USAID, and they had their grant or contract just canceled. And so as a result of that, their Vermont contingency was laid off, and that was 150 people. But if there's widespread layoffs with, federal contractors through cancellation of contracts, and, that 3,300 federal civilian employees, if there's layoffs there as well, again, they're losing their income. It reduces their taxable income, which has an impact on them.
And then has an impact on the unemployment insurance trust. We'll have Department of Labor in next week. You may recall during 2008, 2009, when so many people were unemployed, it took a hit. So.
Well, I apologize. We got to the end in Ways and Means, and Representative Kimball asked me, so wait, where was the good news?
Yeah. Well, we look forward to hearing more about tax season. And I know we'll have month-end stuff sometime in May, but will we have something in a week or so to give a general sense of what we heard about with the tax filing date of this week?
Yeah, so I get daily reports from the tax department. It's tough looking at day to day to get a real sense, but
That's why I'm not gonna call you every day.
Yeah, the general.
Maybe sometime next week, we could check it.
General message I'll convey, and that I conveyed to Representative Harrison before we started, was things look fine right now.
Yes.
With personal income tax collections.
Which I would
but we're not,
expect is based on last year.
Yeah, but we're not at the end of the month yet.
Right.
So don't take it to the bank.
We don't. I have to see it first, Wayne.
Your rooms and meals taxes are coming month by month though, right?
Yeah, that's so with meals and rooms example, sales and use, the establishments that collect that tax, they have to remit it on the 25th.
So you
Of
should
each
be
month.
able to look at them, how far back? What's the lag time before you can actually look at a month? So say the month of March. They were reported now, but when will they be in the system so you actually can see the number that was, the dollar value for?
So for the month of March, there's two things. I mean, so I get those daily reportings, and so after the 25th, I'll be able to look at it and see what it kind of looks like. But the more official numbers will be when DFM sends us, they're called Schedule Twos. They basically are a full summary of all the revenue types and how they shook out for the month. And so we get a preliminary run on the first and second business days of the month. And then typically on the third business day, we'll get a final run from DFM, which will tell us sort of the official numbers and how they shook out for the month.
About 3 week lag. So for March, you'd have the more or less official number by.
Yeah, I mean, so the remittance deadline is the 25th of each month. Obviously, there's some processing that has to go into it. So we can look at it on the 26th of each month. It's just a matter of how close to finalized are these? So they do.
Does it need to be, because how much wiggle room there is there between the 26th and the very final?
Well, there's instances sometimes when a company or business will accidentally remits too much and they have to sort that out and actually issue a refund. I mean, that's not like the most common thing, but there are things that can cause the numbers to change a little bit.
But I'm just saying, rooms and meals tax come in and they come in monthly. And so you should be able to track and be able to get some idea of whether or not we're trending up or whether it's been a big up or a big down in a fairly short duration of time. We don't have to wait 6 months to get that information.
Oh, sorry, I understand your question now. So we do actually maintain a monthly tracking, which breaks out all of these tax types. It's posted on our webpage, so you can actually go and see in January, corporate income was this, in March, sales and use was this. So you can actually see the month to month. So sorry, I understand the question now. We do track it every single month. And so if you remember from early on in that presentation, I had those bar charts. That is the cumulative, that's basically looking at it month to month of all the individual tax types broken out. So it's just everything smushed together in that chart.
Okay, next.
So
Any other questions from anybody?
sorry for eating 8 minutes.
No, you did a great job. We really appreciate it, Pat. This is very helpful. We'll sobering, and we'll see where it all ends up. So committee will be back here at 1 o'clock. Dan Smith from the Vermont Community Foundation is going to Zoom in and join us, and then we will be done with the weekend. So we will go off live and be back on.